So, thank you very much for joining me today. My name is Michael Florentiades. I am the Chief Economist here at xm.com, and today we will look at the year so far in the Forex market and what to watch for going ahead. So we are going to start with the historical overview of what happened with respect to performance, and then we are for both the foreign exchange as well as various key assets or investments, if you would like, a less fancy term for assets. And then we will look at the main geographical areas, that is the United States, the Eurozone, Japan, UK, Australia, and China. Finally, as I know quite a few of you are active in commodities and you would like some more views on commodities, we will talk a little bit about crude oil and gold, and then we will talk about what we make of the whole environment, as well as some favorite trades, possible trades, ideas. So I hope this will be interesting for you. So, what should you know about the first 4 months of the year? First of all, the UK pound, which is a little strange. The UK pound rebounded and was the best performing major currency. Now, isn't the UK pound the one that has Brexit? So what's happening there? Well, the pound spent an extended period of time in the Brexit doghouse, as I would like to call it. So since June of 2016, the second half of 2016, it was absolutely pummeled during this period. However, during this year, 2017, we have had a rebound. We'll talk a little bit about that, what's behind that. Then, strangely enough, the euro and the yen did relatively well versus the mighty greenback. If you recall, the dollar was a strong favorite at the beginning of the year to do well, but the euro and the yen, two regions that we still have quantitative easing, so central banks are printing money still, both in Japan and the Eurozone, did well, did better than the dollar, where we had an interest rate increase and we don't have QE. So these are some very basic differences. The yen actually edged ahead of the euro, so it was up 0.25% ahead of the euro, but roughly similar, because a quarter of a percent is a very small change in foreign exchange terms. The Australian dollar was the best performer among the majors, despite commodities not starting the year well. So that was very interesting, because we saw the Australian dollar putting in a very strong performance despite, as I said, commodities not performing as much as needed for the commodity currency to do well. Here, let's see what would be the best year to date. This is like end of April kind of figures. So we see that gold was actually a very strong performer, which was interesting given that stocks also did well. The S&P 500 in the US rose by almost 7% in the first 4 months of the year, which is a strong performance for just 4 months. We have the pound rallying against the dollar, the Aussie rallying against the dollar, and surprisingly enough, the euro doing very well. Copper up, but you see here that the CRB commodity index was down, and one of the year's biggest losers so far has been crude oil. And you see dollar yen, the yen was up 4.8% versus the dollar, which means dollar yen was down 4.8%, obviously. So, as you can see, the best performing assets or investments were stocks. So stocks in Asia, excluding Japan, emerging equities were very well. We say excluding Japan. If you notice the Nikkei 225, which is the Japanese benchmark, it was up only by 0.7%. Why was that? Well, you see the yen, we mentioned it being strong, so all those Japanese exporter shares did not fare very well. So Japanese Nikkei underperformed other markets such as the US, such as developed equities as a whole. Even bonds did well, which was interesting enough because we were expecting, let's say, interest rates to head higher generally in 2017, not to be a very good year for bonds, but they actually managed to bounce back a little bit. And soft commodities doing quite badly, double-digit losses for soft commodities or agricultural commodities, I guess you could say. So for stocks, we said very good. Starting with the US and moving on to Europe, Asia, emerging markets. Actually, Europe, Asia, and emerging markets did better than the US. I just say that we started with the US because there was optimism and we did have a continuing stock rally in the United States, which in turn helps other countries stocks to move higher. These were positive moves, but we are getting increasing concerns about overvaluation. So stocks are getting a bit expensive. We should keep that in mind. So we see that gold also did well. Gold is a little counterintuitive because gold is a safe haven, so it's strange that stocks did well, but also gold did well. Bonds made a comeback from selling at the end of the year last year. And commodities fell. Particularly, there was a lot of disappointment for investors that were bullish on oil because they were hoping that the OPEC and non-OPEC production cuts would bring equilibrium to the market. Instead, what we see is rising US production. Inventory is not going down, so this led the price of oil going firmly under $50 a barrel right now. On to look at our major economies, and we start, of course, with the largest economy in the world, the United States. We had first quarter growth at 0.7%. That is pretty dismal economic growth, 0.7%. It was well below expectations of 1.2%. Keep in mind that these are annualized rates, seasonally adjusted annualized rates. So we had a sharp slowdown in the first quarter, but you know the previous quarters were boosted by some special factors. Also, some special factors pushing Q1 growth, first quarter growth down. First quarter growth in the US has been bad for a number of years now, so there might be some seasonality effect. So what I'm trying to get at is that the market wasn't so scared by these bad growth numbers. Looking ahead, they are more optimistic that US growth is going to rebound for sure. Now, the big question in the United States is, will President Trump deliver on his fiscal plan? How will it affect growth? Will the potential benefits start to be felt in 2017 or later on? Some are saying any Trump tax package might pass as late as August, so it's not going to affect this year so much, if at all, if it passes at all. So this is an open question. Inflation in the US is relatively high, 2.4% year on year. It's not a low inflation rate. Although the Fed's preferred measure, the core PCE price index, just came in the other day at 1.6% year on year. It's close to the Fed's 2% objective, but the Fed is not as scared about inflation right now. The unemployment rate, I would point out that it's very, very low at 4.5%. It's the lowest since May of 07, so exactly at the 10-year low unemployment. This is a pre-crisis low, so very tight labor market in the United States, but we'll have to see if that is going to push up wages, because it seems that there are some new entrants in the employment in the workforce, which is keeping wages a little low. Here you can see inflation, which is quite a bit more volatile than what the Fed likes to watch. This orange line, which is the core PCE, personal consumption expenditure index. We have the unemployment rate, which is falling. It's now down to 4.5%. And this is the non-farm payrolls that you can see here, holding on relatively decently, actually. I mean, we haven't really gotten any extremely low numbers in recent months. And no analysis of the United States could be complete without mentioning what is happening with the new President Donald Trump. He made some pre-election promises on infrastructure and lower taxes. This in turn boosted the dollar and the US stock markets. But in return, now we are having some doubts on his ability to deliver on these promises, both infrastructure and tax cuts, particularly after the failure to pass a repeal of Obamacare or the Affordable Care Act. We have some questions whether the new administration's legislative agenda is going to go forward. There are some concerns about trade protectionism. It's not clear that the US is pushing, I think it's rather clear that it's not pushing for more globalization and more free trade. Trump would like to renegotiate NAFTA, the North America Free Trade Area. This can have an effect on Canada and Mexico and their respective currencies. So we are seeing the Canadian dollar and the Mexican peso moving quite a lot to what Trump does or intends to do with respect to these nations. We had the tariffs on Canadian lumber produce imports into the US, so this was quite significant. And the Canadian dollar has fallen, in conjunction with oil as well, has fallen to quite low levels. So we had a meeting with China's president, Xi Jinping. So it was in a friendly climate. So the worries that Trump would somehow lash out at China, they have not been realized so far. Is this does this mean that the trade war fear is receding? Does it mean it has been postponed? And I think we should also pay some attention to the geopolitical uncertainty, the risk. Particularly, we had the missile strikes against Syria. We had the mobilization of naval forces off the Korean Peninsula. So some movements, what is happening within the EU and NATO and their and that situation. So an interesting theme to keep an eye on, definitely. The Fed surprised markets by raising rates during March. Analysts were expecting a hike later in the year. Currently, the rate stands between 0.75 and 1%. We are expecting 2 additional hikes for the rest of 2017, probably one in June, and maybe one in either September or December. We will see about that. There is some talk that the Fed wants to reduce its balance sheet. This is bonds that it accumulated during the QE campaign. So they are now amounting to $4.5 trillion. So the Fed wants to reduce its balance sheet, sell some of these bonds back to the market. So it's an interesting question, what is going to happen for the dollar, for monetary policy, what is going to happen to the Fed balance sheet. And we have had some mixed signals on Yellen by President Trump. He initially attacked her, but his latest comments seem to indicate that he would not mind reappointing her. And we should note that we have the FOMC meeting later today, so that will be very interesting to see what kind of statement we are going to get. And this might give some hints on whether the June rate hike is on course or whether some recent data which have been a little weak are putting a question mark on the June rate hike. These are the ISM surveys. You can see they are comfortably above 50, and we have seen this spike upwards, particularly since the middle of last year and following the election, although we did have some disappointing numbers about manufacturing ISM on Monday. And this is a chart of the dollar index. It's an index of 6 trade-weighted currencies. So it includes the euro, the yen, the pound, are the major constituents. And I think the euro has more than 50% weight on in the dollar index, so it's heavily weighted towards the euro. And we can see that this dollar rally, it has stalled a little bit and it has fallen below the 200-day moving average. It's also below the 50-day. Yes, it's looking positive because the 50-day is above the 200-day, but we are seeing some momentum slowing down with respect to the dollar, and we will talk more about that in a moment. On to the Eurozone. Eurozone growth rate, it was constant at 0.4% quarter on quarter. Very similar performance during the first quarter. We just had the flash estimate of first quarter GDP for the Eurozone, so doing very well actually. So I think that political instability and uncertainty is a major theme for today's markets, and particularly for the Eurozone. We had the Dutch elections, which Wilders lost. He was the leader of the Freedom Party, which was seen as a more populist party, anti-EU, let's say, anti-immigration. We have the recent fight between Macron and Le Pen in France. The market is kind of siding with Macron and maybe would not like Le Pen win, because that would mean instability for the euro. Le Pen has made some statements against the euro and against the EU. Tonight we have a debate, by the way, between Macron and Le Pen. Macron is expected to win on Sunday's elections, so there is still uncertainty, political uncertainty, that we are going to get the German elections later this year, but I think the biggest risks so far seem to have gone down, not as scary as they were at the beginning of the year. Of course, what is going to happen with Brexit? Another question. Inflation, it's around 1.5%. Core inflation fell from 0.9 to 0.7%, so not really a huge inflation threat. The Eurozone unemployment relatively high at 9.5%, but we should point out it's at the lowest level in 8 years. So yes, high if you compare it to other countries, but for the Eurozone, 9.5% is not so bad and is actually the lowest in 8 years. And we are getting encouraging signs from business surveys that the Eurozone economy is on track to do very well. This is the bright green line is inflation, core inflation, which is holding relatively stable between 0.5 and 1%, so no big inflation there. You see the headline inflation much more volatile, dipping below zero at some point, which is deflation. Energy prices pushed it all the way up to 2%. Here you see the GDP in the Eurozone between 0.3 and 0.6%, very stable, some good economic performance, and economic sentiment optimism by investors. The ECB, we had a ECB meeting last week. It kept interest rates unchanged, and keep in mind that the asset purchase program dropped to 60 billion per month in April this year from 80 billion before that. The ECB is expected to keep the 60 billion pace until the end of 2017. We will see whether it's going to reduce that further. I think for the ECB, we're not expecting a move in 2017, but for 2018 we have to look whether they are going to raise interest rates, whether they are going to reduce whether they're going to reduce the QE further or they're going to taper it completely. So this is something that for sure we are watching, and maybe the June meeting is going to contain some hints on what is going to happen in 2018, because as we said, 2017 it's kind of boring because analysts don't think that's going to be much change. Because I got a question, if anybody would like to get this presentation in a PDF on their email, just leave a comment, leave your email, and we will send it to you. I will say this again at the end of the presentation. It's no rush to do it now. You can do it at the end of the presentation. But if you would like, we can send it by email to you. Now, like we said before, Macron, pictured here, is looking like he's going to win the elections on Sunday. So not a scary scenario for the euro. Angela Merkel is the favorite to win another term. The German elections in September. The next point of uncertainty is Italy, because there we have also, on the one hand, we have a banking problem. We have very high non-performing loans, although coming from Cyprus, criticizing other countries that are having they have high non-performing loans is a little bit ironic. But anyway, Italy right now, in terms of big economies, has a non-performing loan problem, which is affecting the banks. It's affecting maybe they will need recapitalization, or where to find the investors are hesitant. Is the state going to come in, etc., etc. It's possible that we are going to have general elections next year, and right now the five-star movement, which is Italy's populist movement, is leading in popularity. Now, okay, the five-star movement, I don't think it's as anti-EU as Eurosceptic as some of the other forces that we saw, maybe like Le Pen or Wilders in France and Holland respectively, but it's still something to watch if we get a five-star movement, and whether they manage to form a government is another question. So these are all questions about Italy. We'll have to see what happens. And there are also some other issues in the Eurozone: terrorism, migration, what is happening in Greece, despite the recent deal. Euro has had some positive action. Here you can see the gap after the first round of elections on April 23rd. So this is the gap higher of the euro. It was a very favorable outcome for the market. Macron coming in first, Le Pen second with some distance, and the other candidates being eliminated. So we see some of this French election optimism responsible, let's say, for the strong euro versus the dollar. And as you can see, I mean, it's been some time, it's been quite a few months since the euro managed to climb above its 200-day moving average. On to Japan. Japan's fourth quarter growth was 0.3%. It's not so bad. I think that the slowly growing economy, Japanese economy, inflation is positive. CPI inflation excluding fresh foods was 0.2% year on year. Yes, it's not deflation, but it's very far away from the Bank of Japan target of 2%, and it's very hard to guess when the Bank of Japan target is going to be met, which means that QE is going to go on, etc., and very low rates. Unemployment is very low at 2.8%, but wage growth is not happening. So as wages are not going up, consumer spending is not going up, and growth subsequently stays depressed. Now, exports were up 12% in March. This was good export performance despite the fact that the yen was on balance a little stronger this year. Maybe it was the yen dropped a lot following the US elections, but then it made a bit of a comeback, so maybe it's the effect of the very big drop in the yen around last year following the US elections. You see inflation climbing above the zero ground, GDP quarter on quarter very low, because these were figures that were coming out showing that growth in Japan is something that is lacking. Exports are going up, and here you can see the yen on an inverted scale of the yen. So this means it's more or less shows the yen is weakening, and then weakening a lot after like September, October 2016, and following off, jumping off a cliff really after the elections, but then recovering a little bit this year. What is the Bank of Japan doing? We have targeting the yield curve, and it targets the yield of the long-term 10-year Japanese government bond instead of increasing the monetary base, so printing money, let's say, at a steady pace. So this means that it has a flexible asset program. The size of the purchases vary. They can be up or down, but they try to keep the 10-year yield around 0%. Well, there is some accusations that like the monetary policy, like increasing monetary policy in Japan, or using monetary policies like beating a dead horse, let's say, because it has been used so much that it's not exactly going to be so effective from now on. The Bank of Japan is really running the most aggressive monetary expansion scheme in the world. So this is something that we should keep in mind when we are talking about the yen. A lot of yen being printed. Yes, the yen is a safe haven, but we have to keep in mind that QE in Japan doesn't seem to be ending anytime soon. So, nevertheless, we saw that there were after making these highs in December 2016, we have seen a retreat of the dollar, finding a bottom around 109. So the dollar against moves is a combination of US rates, Japanese money flows, and safe haven demand. It's not always so much about the QE and economy. On to the UK, decent growth, although just below estimates for first quarter. Inflation is high. We have the effect of the weaker sterling. Upbeat businesses, they are optimistic about the future despite the Brexit woes. Unemployment is at the 12-year low. Consumer confidence, retail sales are starting to weaken a little bit. So this could be a problem. We will see what happens now that Brexit negotiations are starting, and if they go smoothly, if they are not going so smoothly. So retail sales, you've seen how high they were after Brexit, very, very high retail sales. The purple line, pink line, purple, sorry. So we have the unemployment rate continuing to drop, which is interesting, and inflation rising quite strongly because of the pound. We have a base rate of 0.25% right now, but there was a little bit of a shock to the markets when one of the MPC members voted to raise rates during the last meeting. Okay, this member that voted for a rate rise is an outgoing member, so it's leaving the committee, but still it was a shock because many in the market felt that if there was going to be a move by the Bank of England, it would probably be a rate cut or more QE. So to get a message in the other direction was a bit of a shock in the market. Maybe it helped the pound to steady. Of course, we have high inflation in the UK. It's above the 2% target. So we will see maybe the Bank of England might not be so aggressive with targeting inflation because it doesn't want to hit the real economy with rate hikes at a time when there are important shifts, structural shift, and is coping with Brexit. So analysts are expecting the bank to remain on an easing bias because Brexit negotiations could bring some economic turbulence. So the Bank of England, needs to be on guard to reassure markets if there is any bad news from Brexit. So we had the triggering of Article 50 on March 29th, a very important development. However, it seems that Prime Minister Theresa May and the Conservative government is focusing on a hard Brexit. So it's very inflexible on the issue of immigration control. So being inflexible on immigration control is going to mean a sacrifice of single market access. So it's an open question. We did have some comments that the EU is for sure going to reach a deal. Some other reports are showing that it's not going to reach a deal. So it's uncertainty. I mean, there's a lot of uncertainty. What kind of deal will the UK get from Europe while it's trying for Brexit? Now, the UK services firms are unhappy about hard Brexit because that could lock them out of the EU market. so especially the financial services sector. Now, we have general elections on June 8th. This was a tactical move by May to strengthen her hand, to strengthen the ruling Conservative Party, because they were leading in the polls and they wanted to cash that in. They had a very strong lead over the Labour Party. Of course, this lead has been shrinking a little bit, not worryingly so, but it has shrunk a little bit, so we'll see what's going to happen over the next month or so until the UK elections. So, elections really managed to boost sterling. They thought that there would be the UK would come out stronger versus having the current government with its current majority and being constrained a little bit in parliament. And now there are some issues that continue to surface. Let's say what is going to happen to Scotland. Not so worrying so far. Maybe the elections are going to shed a little bit more light on what is going to happen to Scotland, whether it's going to go for an independence referendum near the conclusion of the Brexit talks. And we also have the Irish border issue, because if the UK leaves since the UK is going to leave the EU, it should have a hard border with Ireland. So what is going to happen there? That's another question. So you can see that pound dollar had more or less found a floor just below 120. It's currently around 129. So we have seen a big move up, and the sterling has been. This is the jump on the announcement of elections, and sterling has been above the 200-day moving average, something that has not happened since Brexit, since the Brexit vote. So it's a significant technical development. Same with the euro pound, that we are seeing some strength in the pound there. On to Australia. Very good growth in the fourth quarter. It's growing nicely. Annual inflation jumped to 2.1%. It's in the Reserve Bank of Australia's target. Unemployment rate kind of high for Australia at 5.9%, but it's looking positive. Maybe there are more people entering the labor force. Full-time jobs are increasing, so these are positive signs. China is not doing so badly, and this is a positive for the Australian economy. There are a lot of people who are very worried about what's going to happen to China, but China is keeping its growth momentum, and China is Australia's largest customer. So you can see, I mean, it's like a business. If your largest customer is doing well, business is going to be a prosperous one. The RBA cash rate is at 1.5%. We had 2 cuts last year. Some people were speculating that maybe the RBA is going to raise rates this year, maybe because there was a housing bubble forming in the country, but it's unlikely to come soon. And inflation, we said, inflation is not so high, unemployment is not so low, so this is more or less steady for about a year. This is what analysts are expecting. Australian rates to stay steady for about the next year, and let's say the RBA is going to play it by ear and see what the economy does and react to it. But more probably to hike rates rather than cut rates further. There was like a shock in the third quarter that we had negative growth, but since then we have seen growth in the fourth quarter rebounding smartly. The Aussie I mean, it has rallied strongly from around 70, but it has been kind of a range most of the year. It's not clear to see a trend for the Aussie because I mean, it's around from 0.74 to 0.77 and a half. So this is more or less the range near the 200 day. 200 days more or less flat over there. On to China, the world's second largest economy, although the renminbi or the yuan is not so much traded in the foreign exchange market as the other majors. Very good growth for the first quarter, 6.9%. It was the strongest growth rate in 2.5 years almost. 1.5 years. The inflation rate, not so good, but 0.9%. And very strong producer prices. Producer prices are the prices that companies are paying. So 7.6%, that's a very strong increase in producer prices. The Chinese benchmark rate is at 4.35%, and the yuan is a little bit down versus the dollar since the start of the year. Now with Trump, I think the Chinese are a little bit more careful not to weaken the yuan too much, because that is going to that might bring some reaction from Donald Trump and his administration. And we also, this could become a political issue, so it's important to watch. But I have also put in parentheses the issue of North Korea. The US needs Chinese cooperation to deal with North Korea. So I think given the very pressing issue of dealing with the North Korean nuclear threat, it doesn't look very likely to that Trump is going to go after China as hard as he hinted during his campaign. So that's a positive for China. So they're not going to get involved, for the moment at least, with any trade wars versus the US, because the US needs the Chinese. I mean, it's a very important relationship between these two countries, but also in order to deal with North Korea. Manufacturing PMIs, they are showing they are above 50, showing expansion. We have good trade numbers, but we have to watch the trade surplus, especially with the US, because it could be a sensitive issue to create tension between the US and China. And we have risks also in we have had a lot of credit creation in China to support growth. So maybe this is, if it creates a debt bubble, it could burst in the future and create a lot of problems for Chinese banks. However, this year the Communist Party, the ruling party, wants everything to go very smoothly because we have the National Congress of the Communist Party. It's an event that takes place every 5 years, and it's a key event to watch for the Chinese and the Chinese leadership. Here is Chinese growth. Here is the manufacturing PMI holding on quite well, and industrial production turning positive recently. And this is the chart of the yuan holding steady for, I mean, it's hard to see how we have seen, because an increase, keep in mind, is means that the yuan is depreciating. So, I mean, it hasn't really depreciated much, particularly if we see since Trump's election has been more or less steady, hasn't broken through 7 or anything like that. On to commodities. We had this OPEC, non-OPEC agreement to cut output by 1.8 million barrels a day, but it seems that the US production is making up for these cuts, and it does not seem to be enough to alleviate to bring down inventories. So as it's not doing enough, maybe they will extend the output cuts beyond the first half, although it's going to be interesting to check whether, let's say, a country like Russia is going to be on board. If they're interested in continuing to be part of the deal. So we had a range of $47 to $55, but this below $50 a barrel has been a little bit of a surprise because people were expecting the OPEC, non-OPEC agreement to push the price more towards the 60 level, and these are the forecasts for of oil analysts. They see that by the first quarter of 2018, according to analysts, the oil price is going to be closer to 60 rather than below 50, which it is right now. Has been a very choppy ride, very volatile 2016 for crude oil, and continues 2017. We are seeing also some problems. Finally, with gold, it has climbed 9.1% year to date, which is strong performance for the yellow metal. However, we see that the political risk that a lot of people were afraid of, particularly in Europe, did not materialize. So in the last couple of weeks, we have seen gold falling. It made a 5.5-month high of 1295.48. So this is the high this year, and it's more or less around, well, just now it fell just below 1250. So interesting, quite a sharp drop for gold. Still, we have risks, and this safe haven allure of gold could help it benefit. We have some unpredictable moves by President Trump, what is happening in North Korea, in the Middle East, what is happening with Russia, the Eurozone issues, etc. So it seems that there are plenty of reasons for people to buy gold if they are scared, but nothing really ugly has happened to push gold north of 1300, let's say, right now. And here you see the strong dollar after the US election pushing gold down, but so far, and also the US Treasury yields, which are inverted, so the higher the yields, the less demand for gold. So and some drop in gold demand following the French election. So to sum up, the dollar's attractiveness could be fading a little bit, I think. Yes, everyone has been long dollars since the Fed started to raise interest rates with the expectation of more, but we have worries about how effective Donald Trump is going to be in boosting the US economy. The Fed is expected to keep raising rates, but at a very slow pace. So this is kind of hurting the positive momentum of the dollar. The euro, on the other hand, is gaining some traction as political uncertainty dissipates. And we expect the ECB to tighten policy in some sort of way. We don't know how exactly, but 2018 probably the ECB is going to stop with these negative interest rate policies and maybe reduce QE. We'll see. The pound seems to have found a bottom because it has a lot of economic disaster, let's say, has been priced in right now. So it seems to be rebounding on more positive developments. The yen is a safe haven, but the Bank of Japan is the bank that is furthest from normalization. What do I mean by normalization? Well, having a positive interest rate and stopping QE. As long as you have very low interest rates and do QE as well, it's not normal, not monetary policy. Okay, you normalize if your economy is doing well, if inflation is doing well, and in Japan, these things are not happening anytime soon. Now, I would just point out that the yen is a safe haven, but in the case of North Korea, it I think the country is too close to Japan for comfort. So if there is a flare-up in North Korea, then the yen might not be the best safe haven in the world because Japan is right in the neighborhood. The Australian dollar, well, is dependent on risk sentiment and commodities. If they continue to do well, I think it will continue to move higher, but it's not expected to move to get any benefit from rate hikes. Other assets outside FX. Stocks, we said, equities are moving higher, but there are concerns that they are overvalued. Bonds, I would say right now, they are mostly dependent on monetary policy. So we have the case of the Eurozone bonds, which are very dependent on the negative rates and QE of the ECB versus the Fed. US bonds are trading, let's say they have some positive yields because we are expecting the Fed to hike rates. So it's difficult to make generalizations with respect to bonds, I think. Now, commodities, the big story there is that the energy sector is hit by oversupply concerns. Soft commodities or agricultural commodities also down. Industrial metals are mixed. I think the message that we are getting from commodities is that global growth is a little bit slow. It's positive, but it's not something too exciting. It's interesting with emerging markets. There were a lot of concerns that these countries would get in, some emerging markets would get into trouble because the Fed was going to raise rates, that the dollar was continuing to get stronger. But now many people are bullish emerging markets because they are cheaper than developed markets. So some people are placing bets there. Now, let's talk about favorite trades. We were a little positive in January about the euro. That was the right bet. But we were wrong on sterling because we said that, okay, there was some value in sterling, but there was the momentum down. The yen also fell. We were expecting the yen to fall. The yen rose a little bit. So let's say not so good track record. I think 1 out of 3. It's interesting. Now, let's see more going forward. The US dollar, it's looking range bound for now. I think that the initial optimism on what Trump and his policies are going to do has faded. We do have the Fed rate hikes. They are supporting for the dollar. I think maybe the dollar could be a good bet and a good buy after the French elections. Why am I saying this? Because if the euro continues to bounce higher following the French elections, but the range of euro dollar stays in place, which has been, let's say, a range of 105 to 110, then that would be 109.50 to 110 would be a good attractive place to buy dollars, sell euros with the goal of trying to get to get back into the range. The euro is positive right now. It has diminishing political uncertainty. It has good economic numbers. It has the possibility of ECB tapering. So the euro is looking a little bit more attractive. I fear, though, that it has limited upside until we get some higher inflation and maybe some ECB plans to raise interest rates. The pound is looking like it has bottomed for now. So I think it's focusing on Brexit and political developments. It's going to stay very volatile and very reactive to political developments. So I would say with the pound there is some bottom fishing because also the technicals have changed. They are a little more positive. It's not going to go on an uptrend, but maybe it's worth to buy the pounds during dips. It's not a bad idea. Please, if you want to ask some questions, please input them to your, try to key them, and I will do my best to answer as many questions as I can. Please keep in mind that we have our research page, xm.com/research, where we put up all our analysis, market reviews, analysis videos, etc. And also you can subscribe to our YouTube channel, where we have quite a few informative videos. Thank you very, very much for watching this webinar presentation. I hope you found it useful, and I look forward to answering any questions that you may have. Please feel free to ask away. Thank you very much. Yes, there is a very interesting question about whether President Trump is going to go for a strong or weak US dollar. I think he has indicated a preference for a weaker US dollar, but I don't think it's so much up to him to be able to dictate, let's say, where the dollar is going to go. I think it's more with respect to the US fundamentals and with respect to monetary policy. So I think that yes, on the one hand, it's an issue for if President Trump is going to talk about a weaker currency, but at the same time, I don't think it's going to be something that is going to, in itself, weaken the dollar so much. Probably prevent the dollar from rising much higher, but I also think he has the power to influence the dollar in this way. Another question, I think that following the French elections, the expectation is that the euro is going to open higher. So market is expecting a Macron win. If that materializes, I think that then political uncertainty is reduced. However, since this is the main scenario, the scenario that the market is more or less discounting, I don't think it's going to result in a huge move for the euro. So I wouldn't expect a big rally by the euro. Maybe it's going to test 109.50, which is the 5.5-month high, but not a huge rally beyond that, because this is what we are expecting. And if something happens which we expect to happen, we should not see a huge market reaction. But it doesn't mean that it's not. I mean, it's something to ignore, because this political uncertainty has been a big theme for the euro. Now, will the UK quit the EU for good? That is certainly what the current Conservative government intends to do. So it would be a huge surprise if we see a reversal of the decision to quit the EU. Now, I think that we could get, if there are quite a few scenarios now in how hard Brexit is going to be. If at some point it starts to look that the economic cost of Brexit is going to be extremely high, then it might be possible that the UK government is going to try to moderate, let's say, what it tries to achieve and go for a more Swiss style or Norway style kind of deal. But I don't see, with the so strong feeling on immigration, I don't see that as a very realistic prospect, to be honest. But at the same time, we have seen that the pound, despite the hard Brexit process, the market has said it's enough it has pushed the pound down enough, and maybe it has found some kind of prospect. Now, what were the factors in favor of gold to reach a 5.5-month high? Well, it's very interesting. I think that was a little bit of geopolitical uncertainty was one issue. Another issue was that I think we got a little bit weaker US data, a little weaker US data, which might have taken some of the willingness of the Fed to raise rates quickly away. So this is also helping. This also might have helped gold. The other fact was that the Trump stimulus in terms of infrastructure and tax cuts was also not happening very quickly. So I think all these factors were conducive for gold, although gold was also challenged by the fact that stocks were rising and there was positive risk appetite. I mean, if everybody wants to hold shares and they are going up, why should they own any gold? If it's not really, if the world is a safe place and stocks are going up, then the incentive to hold gold kind of gets reduced. So I think this is what capped also the rally in gold at 1295, and you didn't see above 1300. 1300 was the last hit by gold on the eve of the presidential election in the US, but since then the strengthening of the dollar has pushed it down. Now, with respect to palladium, I think it is, we haven't talked about this kind of metal, but because it's a combination of a precious metal and an industrial metal, we have to see if global growth is going to be good and if there's going to be strong industrial demand. So this is how I would go about to check about the metals such as palladium, to check, because I think it's used for very specialized applications in industry. So you have to check demand and supply there to try to get it accurately. In the French election, what happens if Macron does not win? I think that would certainly be a surprise to the market, and we would see quite a vicious turn for the euro. I mean, maybe losses in excess of 5% for the euro, which is a huge move. We would also see a sell-off in shares, although even in the case of a Le Pen victory, we would have to see what the actual policies she implements will be. I mean, yes, she has spoken of doing certain things. Yes, I mean, I think it will be bad for the markets for sure. But at the same time, I don't know whether it's like an end of the world scenario, because we have also had the experience with Donald Trump. I'm not saying that they are the same. I'm just saying that the market, yes, prefers one candidate to another, but even if there is an upset, it doesn't mean that you should be evaluated, because what politicians say and what they do is sometimes two very different things. All of those who have sent me your emails, rest assured that I will send you the presentation. So, thank you very, very much for your attention, for your questions, for participating in this webinar. Again, I hope you found it interesting, and I hope you will be with us for future XM webinars. Again, thank you very, very much, and have a great day. Bye-bye.